Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for Westshore Funds. He's the former general counsel of long-term capital management. He's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. It's great to be with you. Thank you.
We also have with us Alex Stanzik, Managing Director of Physical Gold Fund. Hello, Alex.
Hello, John. Likewise, great to be here.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. Well, Jim, here we are, June 23rd, 2016, and back home, for me that is, not you, it's Brexit Day. As we speak, my fellow countrymen in the UK are deciding whether or not to leave the European Union. It's a cliffhanger. Opinion polls have been too close to call. Voting ends in, I believe, just under 4 hours, so as for now, we don't know how this will turn out. But Jim, you've recently returned from a trip to London to promote your book, The New Case for Gold, and I'm sure you heard a lot about Brexit from your contacts in the financial markets there. What can you tell us? What's your first-hand feel of the situation in England?
Well, that's right, John. I just got back from London the other night, Monday night, and it was a fascinating visit, very interesting time to be there. Of course, I love London, period, so there's never a bad time to be in London, but this was an especially interesting time for the reason you mentioned. Look, this Brexit is a big deal. It's not quite, the Battle of Hastings or Agincourt, but I think, or D-Day, but I think in British history, this will stand out as a momentous day. Of course, for the, I'm sure most of our listeners are pretty well informed, but just to do a little bit of background, Brexit is short for British exit, and this is a referendum, so an up or down vote by the British people, whether they should remain in the European Union or leave. And so those are the two camps. Those are actually what the campaigns are called, remain or leave. I actually had the occasion to speak to someone who is he's an economist, but he's volunteered for one of the local polling stations to be a vote counter. I guess they were short of volunteers, and he filled me in a little bit. This is the only issue on the ballot, so it's not a cluttered ballot. There are no other elections going on, so it's very simple. You vote, leave or remain, basically. The question is worded in a straightforward way. They're paper ballots, so they'll take a while to count. So that's the lay of the land. Now, the polls close at 10 p.m. London time, so they stay open a little bit late by our standards, by U.S. standards. That'll be 5 p.m. New York time. But because they're paper ballots and because they have to be counted, and there are no exit polls by the government or the BBC or the networks, I'll come back to that in a second because there are some privately commissioned exit polls that could play a role, but we won't have access to those unless they're leaked. But there are no sort of media exit polls of the kind we're used to in the U.S. So they're just going to have to slog through it. We may, depending on how it goes, depending on which votes are counted first and the distribution, we may get results by about 10:30 tonight New York time. So let's call that 3:30, if I did the math right, 3:30 London time, 3:30 in the morning, that is. But if it's close, if it's really close, it could be as late as, say, breakfast time in London Friday morning, which would be maybe more kind of 1 o'clock in the morning here, somewhat after midnight. So it could be a long night. We'll see how it goes. Maybe faster than that. But as you know, in U.S. elections, they get the votes in, but they have these exit polls, and statistically they can compare them and make a projection long before the votes are counted. But that will not be the case here. They're going to have to count the votes, and if it's lopsided, as I say, we may know by 10, 11 o'clock tonight New York time, but if it's close, not until after midnight our time and really breakfast time in the UK. So why is this a big deal? Well, it's a big deal for a number of reasons. One, a lot of people expect, no one's ever left the EU. This has never happened before. Despite all the stress you heard about in Greece and Spain and Italy and the Euro sovereign debt crisis throughout 2010, 2011, 2012. We don't have to revisit all that drama around Greece, but the fact remains nobody left and things were worked out. Well, this would be the first time, so you have to revisit the issue. Well, if there's an exit, if there's a way out, as simple as a referendum, could others leave as well? So it would call into question the integrity of the entire EU. By the way, the Europeans are, I'm trying to think of that without being vulgar, I'll just say extremely angry at David Cameron, the British Prime Minister, for even doing this. I mean, this was a little bit of a stunt. 2 years ago, they had an election in the UK, and it wasn't clear that Cameron's parties, the Tory, the Conservative Party, they weren't in great shape. And so he said to the voters, look, if you elect me, I'll give you a referendum. So people said, okay, we like that. So Cameron and the Tories were, in fact, elected in a bit of a landslide. But then he was on the hook to deliver the goods. And now we're up to the referendum day, but people in Europe are saying, wait a second, why are you playing with the future of Europe for your own electoral prospects? A good example of short-term political thinking with long-term, potentially disastrous consequences. But why are we surprised that politicians do that? That's what politicians do best, which is put their own interests ahead of the interests of larger groups. But here we are, so quite a bit of annoyance in Frankfurt and Berlin and Paris and Madrid and elsewhere around Europe that this is even an issue, because it does open the door to more people leaving. Beyond that, there are a lot of knock-on effects. Let's see what happens. By the way, right now, this really is too close to call based on all the polls. I mean, you can pick your poll. There's certainly some polls that have shown Remain ahead. Other polls have shown Leave ahead. A lot of these polls, particularly the recent ones, are within 1 or 2 percentage points both ways, all within the statistical margin of error. So just, as an American, I think it's a little bit easier for me to detach my analysis from any, personal preference I might have. That's always difficult to do just psychologically. But being objective about it, I think the fair thing to say is this is too close to call. I don't know what's going to happen. David Cameron said he doesn't know what's going to happen. Nigel Farage, others on the Leave side have said the same thing. So it truly is too close to call. But a very interesting development has taken place, which I think has the potential to rock markets. While the polls are close along the lines I've described, there's another source of information which are bettors, basically betting parlors, Ladbrokes I think being the most prominent, but there are others. There's Betfair, Ladbrokes, some are online, some are apps, etc. Now the odds makers in these betting parlors have set the odds very, very heavily in favor of Remain. As they've said, there's a 75, some as high as 80% probability that Remain will win. So they've given Remain bettors very short odds and long odds to people who want to bet Leave. Now, there's another phenomenon called the wisdom of crowds. This is based on a book by James Rickards 5 years back. Excellent book, by the way, good writer, did his homework. I read the book. I use it myself in my own writings. And it says that if you have a very large group of people, and even though they're not expert, even though they may not be that well informed, if you have enough of them and ask them to express a view on something and you average that view, that is very likely to be the most accurate estimate you can get of the outcome of some uncertainty. It does better than the experts. Now, the classic case of this, I'm going to spend a minute on this because it's really important to understand. It gets right to whether you should buy gold, believe it or not. But the classic case is, guess the number in a jelly bean jar. Misstated. Guess the number of jelly beans in a jelly bean jar. So they'll put a big jar of jelly beans on display, and they'll invite passersby to guess how many jelly beans are in the jar. Now, they'll get some physicist or some engineer, and the engineer will sit there and, calculate the volume of a single jelly bean and the height of the jar and the circumference of the jar and make allowance for space between the jelly beans because they're irregularly shaped and write the equations and all that. That's the scientific way of doing it. That guess will usually be worse than just people who say, I think it's 1,000, I think it's 10,000, I think it's 100, etc. And the reason for that is if you have a large enough group, some people are going to make ridiculously high guesses. Some people are going to make ridiculously low guesses. Most people are going to try their best without the benefit of the science of the engineer, etc. But when you aggregate them all and average them, you'll actually get a very accurate result. This has been proven in many, many experiments. Whereas the engineer will, in all his lines of code and calculation will make some error that throws him off a little bit. So that's the basic theory of the wisdom of crowds, that large groups of everyday citizens guessing produce better results than experts expressing a single point of view. And that's good science, and that's true. Now here's what's happened, and this is a good example, John, of the old saying, I'm sure you've heard it, a little learning is a dangerous thing, which means if you're ignorant of something and you know you're ignorant, you can take precautions. You can say, hey, I just don't know what I'm doing here, so I'm going to be careful. If you're genuinely expert and you're confident in your expertise, you can use that accordingly. But there's nothing more dangerous than the person who thinks he's an expert and isn't really, and goes ahead with great confidence and makes a blunder. That's, by the way, that's a pretty good description of the Federal Reserve, but that's a very, very problematic situation. I think what has happened here, as best I can tell, is that people take this wisdom of crowds meme, this idea that somehow an average of a bunch of people acting together is better than any expert view, and they've applied it the wrong way. They've applied it to betting odds as opposed to the polls. The polls tell us it's too close to call, but they're looking at these 70, 80% odds in Ladbrokes or Betfair and saying, well, see, it's clearly Remain, and the markets have now priced in Remain. Now let me just spend a minute on what's wrong with that, why you can't take the wisdom of crowds science, which is good science, and apply it to betting. Number one, you'd have to assume that the betting pool is the same as the voting pool, because in a vote, all votes are weighted equally. But in betting, I can come in and bet, $10,000 on Remain, and somebody else could come in and bet £5 on Leave, and they're going to give me, short odds. They're going to give the other guy long odds because they don't want to be wrong. Bookmakers are pretty smart. Bookies are pretty smart. They don't want to take a view. They just want to make a little big on the difference. So they have to balance out the odds. So that's why they're going to give me short odds in that situation. But that doesn't mean that it's an expression of 70% of the people voted Remain. It just means that I put down a lot more money than the other guy. Now think about that for a second. Who has big money to bet? Bankers, elites, maybe journalists, people in London, people who clearly favor Remain. Who's going to bet, a fiver or a tenner? It's going to be the pub owner, the everyday citizen, etc. Now, what's interesting when you look behind the numbers, there are far more bets on Leave than there are on Remain. As if all the bets are weighted equally, which they're not, but if they were, Leave would have 80%. But it's because the big money's on Remain that you have to shorten the odds. So in other words, the betting odds are a reflection of how betting works and how bookmakers set odds so as not to lose money. But it doesn't mean that there's a 70 or 80% probability that Remain wins. What it means, what they're really saying is there's a 70% probability that Remain gets 50.1% of the vote because it's a binary outcome. So those odds are not equal to an expected vote. They're equal to a weighted vote of a non-representative pool of bettors. And remember, bettors are not betting what the voters are doing. Bettors are betting what they think the voters are doing. So you've got all kinds of cognitive biases in there. And there's also a filter, which is, you need money to vote, to bet rather. You don't need money to vote, but you do need money to bet. So the betting pool is skewed in favor of people who have money to lose, whereas the everyday citizen or subject in the UK might not have that. So, and when you do these wisdom of crowds experiments, there are no barriers to entry. Anybody can go up and guess the number of jelly beans in the jelly bean jar, guess the weight of the cow at a county fair, and so forth. So, look, I spent 10 years developing prediction markets for the CIA, so this is something I know a lot about. They are enormously powerful, but they have weaknesses, and it's like a kid playing with dynamite. You have to understand how the dynamite works or you're going to blow yourself up. So I think that there's been a misinterpretation of what these betting odds really mean. Now, that doesn't mean Remain won't win. Like I say, it's too close to call. I don't know what's going to happen. It could be Remain, it could be Leave. What I do know is that the markets have taken this betting data, I think misinterpreted it or overinterpreted it, and they've priced for Remain. So right now, markets are priced for Remain. The gold has gone down, the sterling has rallied, British sterling has rallied, stocks have rallied. There's a whole set of market consequences that have priced themselves in expectation of Remain winning, which in turn is based on the betting odds, which in my view is a over or misinterpretation of what those odds really mean. So everyone's leaning on one side of the ship. This is a fantastic trading opportunity for those who are interested because the thing is priced for Remain. So what does that mean? Well, if Remain wins, not much is going to happen because the markets have already discounted that result. The markets have said, we think Remain's going to win. So if Remain wins, it's like, okay, now what do we do? And there's always something going on in the markets. There's always some volatility, but gold is about where it would be if Remain wins. Sterling is about where it would be if Remain wins. So you're not going to get a lot of juice out of those trades if Remain wins. On the other hand, if Leave wins, that's an earthquake. You're going to see pound sterling drop 10% almost instantaneously. The biggest one-day drop of any major currency, I don't know, at least since the Washington Accord, 1971, when they devalued the dollar about 17%, but you can see that coming. Gold, I would expect, would super spike. I would expect gold to go up 10%, again, almost instantaneously. Gold mining stocks might go up 20%. We're not here to as investment advisors, but as an analyst, I would say that you're going to see earthquake-type moves if Leave wins. So I'm looking at this, I'm saying, okay, the polls and everything I hear tell me it's 50-50, but the markets have decided, for whatever reason, to price in one of those two outcomes big time. So, and if that happens, nothing else happens, but if the other outcome, namely Leave, happens, look out below. And so sometime late tonight, because the markets never close, right? London will be closed, New York will be closed. Actually, London will just be getting ready to open, but Asia will be open. Gold, currencies, these things trade 24 hours a day. We're not going to have to wait till Friday morning in the New York Times to see the impact of this. If Leave wins, that earthquake is going to start in Tokyo and it's going to rumble around the world. Now you're into the potential for contagion, which is, as the saying goes, what happens in Britain doesn't stay in Britain. Why should a currency move 10% in one day? That is what's going to happen if Leave wins. There's no good reason for that. It just shows you how unstable the monetary system is. There's no anchor. There's no gold standard. There's no fixed exchange rates. This is just jump ball. So sterling goes down 10%. When things like that happen, John, somebody goes out of business. I've seen it too many times. Somebody's on the wrong side of the trade. Some hedge fund will fail. Some dealer will close his doors, house closed, as they say in the UK. And then the counterparts will say, oh, gee, where does that leave me? Everyone's going to want their money back. You have the makings. I'm not predicting this, but I'm saying you have the makings of a global liquidity crisis where the central banks are going to have to step in. It could start to look like 2008 query, whether it will go all the way or whether they'll snuff it or whether it will even happen. Because, I do agree if Remain wins, not much will happen because that's already priced in. But basically, you're looking at a coin toss, 50-50, Leave Remain. You're looking at a coin toss. If it's heads, not much happens. But if it's tails, we could be looking at an instantaneous 2008. That is a crazy situation. Thank you, Prime Minister Cameron. But what it means, I bought some gold the other day because, I like it anyway. I like it at this level. But if Remain wins, not much happens to the price of gold probably, but I like my position. But if Leave wins, I could make, $100 an ounce in a heartbeat. It's a very volatile, very unstable, very interesting situation. It's got a lot of stuff behind it, a lot of drama. Put the coffee on, stay up late, folks, because it's going to be an interesting 24 hours.
Well, thanks, Jim. So in a way, that clarifies an understanding of the gold situation. There's just one thing about the gold part that I don't quite understand, which is with all the uncertainty, this toss-up situation, wouldn't we expect the price of gold to have risen somewhat? Does the betting odds alone account for this slight depression in the price of gold? It seems a little strange to me.
Well, as far as I can tell, yes, because we all know gold's been on a roll since late last year. It's the best performing asset of 2016. But we have evidence, John. It's not just guesswork, because when the middle of last week, where are we now, 23rd, so let's say June 15th, the polls were showing a pretty healthy lead for Leave. It wasn't, a slam dunk, but the polls were leaning Leave. People seem to be trending Leave. And that's when gold went up to 1305 or so. I forget the exact high tip, but it was somewhere around there. Maybe I'm wrong, maybe a little bit higher than that. But, somewhere around 1305, $1310 per ounce. Then the polls shifted a little bit to Remain, and gold went down a lot. It went down $50 an ounce, down to around 1260. So that tells us that gold is, in the short run anyway, this is not a long run analysis, but in the short run, gold is trading based on the market view of Leave and Remain. The only point I'm making is that the market view is based on the betting odds, which are not a reflection of the polling data and the real odds. The real odds should be 50-50 in an equally weighted contest, but because of the composition of the betting pool, wishful thinking, cognitive biases, the wealthy favoring Remain, the everyday UK subject favoring Leave, somebody's 10,000 pound bet versus somebody's, 10 pound bet, and how bookies, you got to understand all this stuff to know what these odds really mean. That has skewed the market. So gold right now is kind of priced for Remain. Look, I mean, anything can happen. We all understand that. But the more fundamental trend, and the reason I've got gold going up, is going back to the Shanghai Accord, which we talked about earlier, which is this weak dollar play. So the dollar price of gold, as I've said before, is just the inverse of the dollar. So if you expect a strong dollar, look for a lower dollar price of gold. If you expect a weak dollar, look for a higher dollar price of gold. I expect a weak dollar because the U.S. economy is not too far from recession. They don't want China to break the peg to the dollar. China needs help. So the whole thesis of the Shanghai Accord was that the dollar and the Chinese yuan would hold hands and stick it to the yen and the euro, which would then have to be the strong currencies. I did not have sterling in the Shanghai Accord because it wasn't that important, because the four units I mentioned, U.S., China, Europe, and Japan, are almost 70% of global GDP. So they're the main event. So that weaker dollar, higher dollar price for gold trend is, let's call that the meta trend, which is why I like gold and at these levels. But intervening in that was a short-term downdraft, which was clearly related to the odds of Brexit and people bidding up the price of gold because of the impact of Brexit, and then letting it get knocked down again as Remain seemed to prevail based on the betting odds from Betfair and Ladbrokes. So, okay, there we are. The higher price trend is still intact. My long-term target of $10,000 an ounce in a collapse of confidence in the international monetary system is still intact. So my intermediate and long-term higher trends are intact. I see a short-term downdraft because of Brexit. To me, it's a better entry point. And if, like I say, if Remain wins and tomorrow's a non-event, I haven't been hurt, I still like gold. But if Leave wins, boy, you could make a ton of money in one day.
Great. Okay, thanks for that clarification. Well, let's just shift for a moment from the monetary aspect of this to economics. Apart from a few advocates of the Leave campaign, the academic economists as a community seem to have taken a pretty unanimous stance on the Brexit. They predict nothing but trouble from the UK leaving the European Union. Do you share their pessimism economically?
First of all, you're right, John. Just to summarize, mainstream economists, the MIT, Oxford, Cambridge, Polytech crowd have described this, what will happen to the UK as a result of Leave is a cross between the Great London Fire of 1666 and probably the invasion by William the Conqueror. So, yeah, it's just the worst thing that's happened in the history of the UK. My retort to that is, can someone please tell me the last time economists were right about anything? I'm sure our callers, if we could all kind of raise your hands at once, I would love to have someone raise his hand or her hand and tell me the last time an economist was right about anything. So I don't put much weight on what economists say because, as we've said before in prior podcasts, they're working with obsolete models. They don't understand the dynamics of risk, the dynamics of markets, the dynamics of economics, for that matter. It's why they've been wrong about the impact of QE1, QE2, QE3, Operation Twist, currency wars, negative interest rates. Economic forecasts, they've been wrong about everything by orders of magnitude for about 10 years. They missed the crisis in 2008. They missed the crisis in 1998. They missed everything. They get every forecast wrong and every policy prescription wrong. So why should we believe them about Brexit? So that's one answer. But another answer is there is a problem here, which is if you leave, sterling is really on its own. And I would see sterling going, well, I said it would go instantaneously down 10%. That's because the markets have, I think, mispriced the risk of leaving. But beyond that, or even if it remains and sterling stays where it is, I would expect it to go lower for other reasons. And this has to do with the UK's lack of gold. I think, as again our listeners know, UK sold over half their gold at 50-year low prices, about $200 an ounce, or 45-year low prices, about $200 an ounce, in a series of auctions between 1999 and 2001. So they don't have much gold. However, they are in the European Union, and they could probably join the euro on an emergency or expedited basis if they wanted to, if they needed to, if there was some collapse of confidence in sterling. And Europe has 10,000 tons of gold. So Europe is like a big fat lifeboat. So think of sterling as the Titanic about to hit an iceberg. If the UK needed to hop in a lifeboat, Europe's got a lifeboat with 10,000 tons of gold in it. But if you leave the European Union, you give up that option to go to the euro. I wrote an op-ed, actually it was published today in a publication called The Daily Reckoning, but it said there are two things that might make sense: leaving and buying gold, or remaining and joining the euro. They make sense in different ways. The one thing that doesn't make sense is remaining and staying on sterling, or leaving and not buying gold, because then your currency is just, and of the two, leaving and not buying gold, leaves you the most vulnerable because you have no anchor, nothing to back up your monetary position. There are dangers in leaving, but not necessarily the dangers that the economists are talking about, but other dangers they're not talking about. There will be some immediate impacts. The bank CEOs have, but by the way, you mentioned earlier, I was just in London, which I was. So you hear a lot of stories on the ground that, you don't get on, websites and podcasts and things like that, except for this podcast, because we tell it like it is. But what I heard was that bank CEOs and managers have issued memos to their staff saying, basically telling them they have to vote Remain. Their job depends on it. If Leave wins, there will be massive, massive layoffs. Now, so they more or less threaten their own employees to vote Remain. One guy said, again, I'll avoid vulgarity, but the heck with it, I'm voting Leave. In other words, he'd been threatened by memos from the boss, but was going to vote Leave anyway. Just as a quick aside, I did not meet anyone in London who was voting Remain. And I talked to taxi drivers, shopkeepers, media people, everyday citizens. They were all for Leave. Now, that's not scientific. That's not a poll. That's anecdotal. I understand that. But I was kind of struck by it. I was like, isn't there one person here for Remain? But the Remain crowd are, they are the elites. And a lot of these threats coming from CEOs, they're more about the interest of the bank than the interest of the employees. Let's see if the layoffs actually materialize. But they might. And people have announced contingency plans to relocate to, Dublin, Edinburgh, Paris, not so much Berlin. It's funny. Nobody wants to go to Germany, but they might not mind going to Paris. But the point is, it's not clear how much of those are just threats to get people to vote Remain and how much that will actually play out. Remains to be seen. But look, it's a big deal either way. I'm not going to make light of it. The thing I'm most focused on is how the markets and what is basically a 50-50 bet have all leaned to one side. That sets up a very interesting dynamic if they're wrong.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.